How would you like to see passive income, real pounds or dollars, dropping into your savings account or your bank account every single month of the year? Now that would be nice, wouldn't it? Let me tell you about the power of the dividend investment snowball. It could really accelerate your invested savings more than you could imagine. Stick around to the end and I'll let you know exactly how much my dividend stocks paid me in 2023. Welcome to Destination Wealth. So today we're delving into the exciting world of dividend investing and compounding those dividends to really accelerate your wealth. It's what's called the dividend snowball effect. In my opinion, it's a fantastic strategy that's easy for the beginner investor to understand and can really propel you onto the path of financial growth and passive income. First off, what exactly is passive income? Well, passive income is money that lands in your bank account or your investment account that you don't really have to work for. It comes in from something that already exists, that was set up in the past, and it continues to work for you. Sounds awesome, right? In the realms of investing, passive income most commonly comes in the form of a dividend paid by stocks that you own. A dividend is money that a company pays you out of their earnings, usually twice a year or sometimes 4 times a year quarterly. You get paid this dividend for being a part owner of that business. When you buy dividend paying stocks, you're buying income and you're also buying time. You're buying income as every dividend paying income stock that you own puts passive income into your pocket. But how about this concept? You're also buying time, as every pound or dollar that you earn from this passive income is actually $1 or £1 less you need to earn from your salary. The goal is to earn enough passive income in your account every year so that you don't have to work if you don't want to, and it covers your yearly salary. When you isolate an individual dividend payment, they may seem pretty insignificant. Yet as the dividends accumulate, there'll be a substantial impact on your total returns due to the compounding effect. This is done by reinvesting those dividends and increasing your total holdings. Each year, with larger holdings in those companies, your dividends will grow and grow. Effectively, it's interest earned on top of interest. As time goes on, the power of compounding can make a significant effect to your portfolio. Like a snowball rolling down a hill, it'll pick up more and more snow, growing larger and larger as time goes on. As an example, let's have a look at the FTSE 100. From the 31st of December 2012 to the 31st of December 2022, the price return of the FTSE 100 was just over 23%. Yet, if you reinvested the dividends, the return was over 84%. So if you'd have invested £10,000 in December 2012, the value of your initial investment after 10 years would be around $12,600, based on just index movements, which is price appreciation of the shares. That would equate to a gain of £2,600. However, if you'd have invested £10,000 in 2012 and reinvested those dividends, buying more stock, more shares of those companies, then the value of your initial investment would be over £18,500 by December 2022. So by reinvesting those dividends, you would have taken advantage of that dividend snowball effect, and you could have made almost £6,000 on top of the standard return of the index. This illustrates the profound and influential impact of compound dividend investing. So in this chart, you can see the difference in the impact of dividend reinvestment. The extra gain from reinvesting those dividends is barely noticeable at the start, but as time progresses, the return profile of an investment with and without reinvested dividends is night and day. I decided to start looking at reinvesting dividends and investing in dividend stocks back in 2012. That was when I first really got interested in them. And my first year of dividend returns was a paltry £135. Yep, an average of £11.25 a month. That was on investments of around £11,000. So you might say, why bother? Well, here's why. For the next 11 years, I continued to save. I continued to pay a minimum of 10-15% into my investment accounts from my salary every month. And most years I increased that amount, but not all. So up to 2023, just from two accounts, my SIP and my ISA, my dividend income rose to £6,840, which equated to £570 a month. Totally tax-free, totally passive. For that 11 years between 2012 and 2023, my total income from all my dividends every year came to £30,000. All of this money I reinvested back into the stocks that paid me those dividends. This was done automatically by Hargreaves Lansdown or in the ISA Interactive Investor. Usually these companies, when you reinvest dividends, you get a preferential rate for trading, and it's much cheaper. Let's have a quick look at a real world example. This is Greggs, a company I've owned for quite a long time. I've always reinvested the dividends when they've paid me. Since 2006, has raised its dividend pretty much every year. Every year except for three. One of those being 2011, 2019 when they cut the dividend, and 2020 during lockdown. You can then see that 2021, 22 and 23, they raised it substantially, which more than made up for the cuts that they previously had. Here you can see the percentage increases year on year from 2006 right up to 2023. And in 2019 and 2020, you can see those declines of 66.7 and 100%, and then the increases in the 3 years after. Greggs pays twice a year. One thing I do want to point out that's quite important is the current dividend yield for Greggs is 2.28%, but because of the price, or my average price that I've paid for Greggs over the years, my dividend yield on cost is actually 5.09%, which is a really important factor that I'll go into in future videos. What is interesting though is occasionally Greggs will pay what's called a special dividend. Now, a special dividend they usually pay when they've got some excess cash or had an exceptionally good year, which they have had. So this month, Greggs will be paying me two dividends. One for the standard final dividend that they pay each year, and the second is the special dividend. I'll then expect to receive an interim dividend around October the 6th for £86.03. Here we can see the last 2 years of dividend payments that Greggs has paid me into my Interactive Investor Stocks and Shares ISA. Now, as you can see, let's take this one for example. It paid in on the 8th of the 6th, 2022. Interactive Investor then reinvested that amount for me on the 10th of the 6th, 2022. So it takes a couple of days. Now, if we look at the transaction, they bought 10 Greggs shares, trading at £20.50 at a total cost of £206.03. But the interesting thing here is the trading fees, because it's a dividend reinvestment plan, are £1.03. So I was able to buy £206 worth of Greggs shares, and the trading fees were only £1. Commission was 99p, but I had a trading credit of 99, so that cancelled that off. So you can see the powerful effect of a dividend reinvestment plan. To summarize then, investing in dividend stocks and more importantly reinvesting those dividends can really substantially increase your wealth over time. I'll be covering each year from 2013 up to today in future videos, showing you exactly how many dividends I got paid, what I got paid each month, and the stocks that paid me those dividends, and whether I still own them, and if not, why not. I'll also go into what I look out for when I buy a dividend paying stock or an ETF. So please like and subscribe so you don't miss out on any of that. If you'd like to know how to get started in finding that extra cash to invest in these dividend stocks, then check out this video next.